Okay, so in this video clip, this is the fourth in the series, and we are looking at the Boston HMDA dataset. It's a vintage dataset from 1996, and the data that was used in the Monell, Tuttle, Brown, McInerney paper, we reuse here, and we apply some exploratory data analysis. One of the key questions that was addressed in the paper related to the practices in terms of lending and how minority groups were discriminated against. So there is some prima facie evidence that there was discrimination. We can take a look at that. And we picked this up in the summary statistics. So just to note, we have loaded in HDMA data, and we use the upload into the content folder. So if you want to put data in, you can find that CSV file, and I might just point out where to give you a link to how you can download the CSV, the HMDA CSV file is at this hyperlink, and then you can read it in. Alternatively, you can go through the package on the CRAN repository, but that's very time consuming, and so I don't really advise. And I made one change then on the data set, and that adjustment then by deleting the final entry in the data set, we created this all.csv. So that's done in the previous videos. What we're looking at is primarily the central question here in terms of the paper. We take the data set that's in that paper, and then we come down to looking at the issue of race. Now, is there evidence of racial discrimination in terms of lending approval, lending denial? Well, the data that we have would suggest that out of, if we take the combination of the two, the 2,096 who were approved and the 285 who were denied their mortgages, we have 2,381 in our data set. And when we take the ratio of those who were denied relative to those who, the rest of the entire sample, that's 11% rejection or denial on mortgage approval. If we filter that down, if we take our data set and filter it just for the minority groups, so African Americans and Latino are recorded here as Black in the data set. And when we just look at the minority population and add now there's only, when we look here, how many are in the minority population, it's just the sum of the two. So it's 243 plus 96, and I think that's 339 are in that category. So out of the total population, 339, we have it here, belong to the minority. When we consider the proportions who were rejected here, 96 out of that 339 were rejected. That's a rejection rate of 28%. And then when we filter out the other population, Black, no, in other words, non-minority members in the sample or applicants, and run the same analysis, we find that the proportions who are rejected, who are not part of minority, so we're going with everybody else except Black, and we can see here that only 9.25% of that group are rejected. So is this evidence then for racial discrimination? Well, we had looked at that pretty much already in depth, and we had got as far as considering or trying to control then for other risk factors. So maybe this is not the whole story, and maybe we've got to control for the other factors. Now, in the previous videos, we had considered some of those, and we were looking then at perhaps issues related to public record of credit problems, which is covered in the data set. Now, we can take a look at the data set and just double click, and you can see the headings here. We have debt to income ratio, household expenditure to income ratio, loan to value, credit score or consumer credit score, mortgage credit score, public bad credit record, denied mortgage insurance, self-employed or not, single or not. So these variables are binary. But then unemployment in a given profession. So if you're an applicant coming in from a given profession, are you buying a flat, or are you buying an apartment, or are you buying a house? And then are you part of an ethnic group or not? And then mortgage denied or not, right? So that's our starting data set. And when we consider, then we might like to just examine the degree to which, the question that we might be posing here, when we look at denied mortgage, no, so that means approved, or yes, and we look at the breaking that down using the facet wrap in the tidyverse suite, right? So in our tidyverse using ggplot2, we can break our graph down to cover the different credit scores, consumer credit scores, and we can see, well, if you're in, if you have a credit score of 1, a lot of the time you will qualify for mortgage. You get mortgage approval on application. Some didn't. And likewise here. So most of the time you're seeing for those 1 and 2, it's fairly clear cut. Most of the time you're going to be approved. Over here, it's not so clear. And we can see that there is some kind of correlation between people who have that public bad credit record. So that's where you owe some money, or there's a tax lien against you, or there's been some finding of non-payment of a debt on your credit history, and that's a blemish. Now, it's also clear, even if you have this bad credit history, you still may get a loan, right? You still may be approved for mortgage. That's kind of interesting. So the rules that are laid down here may not be, they may be relaxed a bit depending on other circumstances. So the creditworthiness, there's a kind of an interesting, highly nuanced interplay between the variables. Just because you have bad credit history doesn't mean you won't be rejected for mortgage or denied mortgage. So there can be some kind of relaxation there, and we find that. But it is, if you have bad credit history and you're that categorization of consumer credit, chances are there's a large proportion of blue here indicating it's not good, right? And your chances of being approved for mortgage are reduced. But it is not a linear relationship. It's somehow non-linear, it's highly nuanced. And in that type of circumstance, probably we would benefit using machine learning to get the bigger picture here. But this is a useful part of our pre-modeling, and we would address. Okay, we ran this snippet of code just because I wanted to see what was in the all. And again, instead of 2,381, we have 2,380. So we just deleted the last entry on the HMDA dataset. So for instance, if we come to the very end, there was a very bizarre entrance with unusual values for mortgage credit score, should be whole numbers, consumer credit score, and there's some missing entries here as well. In the all data set, if we double click on that for a moment, what we did was we just removed that final entry just to clean up our data set. So that's how we go from the 2,381 to the 2,380 with the all data set. Okay. Okay, so we can have a look then at the deny and then fill in for denied mortgage insurance. And what we find is the numbers are so small, don't really register. But the blue here, if we do find the blue, tends to be coincide very strongly with not getting your mortgage. So denied mortgage, yes. And part of this might be if you're denied mortgage insurance, banks are a little bit unwilling to take you on because you may not qualify for, or the loan may not qualify to be put into a securitization pool. And most banks want to, when they offer a mortgage, they would like to pass that along into special purpose vehicle and make it legally separate from the bank. And so if there's a bankruptcy down the road, then that there is that legal separation. However, if you don't have mortgage insurance, then maybe the loan doesn't qualify, and that makes the mortgage less liquid. So there is a strong preponderance. If you're denied mortgage insurance, most of the time it would appear you don't get the mortgage. Most. Okay. Other than that, there's not much to add there. When we come down to self-employed, is self-employed a factor that militates against getting a mortgage? Well, first of all, we just look at the proportions and it would seem fairly clear. There's a minority of people who are self-employed, we can then say, okay, can we break that down a little bit further and consider different, it would appear we want to look at different credit scores. So we use that facet wrap syntax available in ggplot. And then we consider on the horizontal axis, did you get your mortgage or not? Right. So the note here, denied, means you were successful in getting the mortgage. But it would appear if we just look here, being self-employed might mean your income, your earnings are a bit precarious, right? Because you don't have stable income and you're going from contract to contract perhaps, but it's not, at first glance here, being self-employed doesn't seem to be correlated with a higher degree of mortgage rejection. So self-employed people seem to be easily able to reasonably successful in getting mortgages. Maybe it's an indication if you're self-employed, you have a certain amount of capital built in to your business, you have a certain amount of assets, and perhaps a certain amount of entrepreneurial flair that the banks are happy to deal with. And maybe you have a strong relationship with the bank, a strong credit relationship. But even those that have weak consumer credit scores, we note here those even in blue that are self-employed, they seem to be successful in getting a mortgage. So being self-employed is not a problem.